Well, across private equity, you've had a dynamic where, particularly leading into, say, the fall of 21, many private equity firms were coming back to the market faster than they had historically and raising more capital. So there was a lot of money and a real acceleration in the money that went into private equity and growth equity and venture capital. Then you had that hiccup in 2021, and you fast forward a couple of years, there's been a lot less liquidity on the back end. So the investors that have a certain allocation of their capital to private equity who have been there for a while, that's probably gone up a little bit because they've been investing steadily, but the distribution side on the back end has slowed materially the last few years. And so in the more mature parts of the allocation space for private equity, think endowments, foundations, certain pension funds, established family offices, they're slowing down their new investments into private equity until these distributions come back. There are other pools of capital like private wealth, some insurance companies, particularly in the private credit world, and some of the newer sovereign wealth funds that continue to deploy capital into private equity. So as an industry as a whole, it continues to grow. Like
On this episode of What the Finance podcast, I have the pleasure of welcoming on Ted Seides. So you've probably heard of him before, and you've definitely heard his voice, I'm imagining, because he has one of the best podcasts out there, which I really enjoy, called Capital Allocators. And I know there's a couple of podcasts that they run through there, and he's also the author of recently released book, Private Equity Deals, Lessons in Investing, Deal Making, and Operations from Private Equity Professionals, which you can see here. And I definitely didn't put it upside down the first time. But Ted, thanks so much for coming on the podcast today.
thanks for having me, Anthony.
No problem. And looking forward to the conversation. And normally I start big, but I'd be really interested in hearing maybe your opinion. You've been in the industry, you've talked to so many people. From what you've heard, what does great capital allocation look like?
That's a nice specific question to start. I love
Yeah.
it. I think it depends on the discipline. It depends what you're trying to accomplish. But if there's a consistency across what you're trying to get to in capital allocation, it's a deep understanding of what you're trying to do with capital. Like what's the purpose of that capital? And then a strategy underpinned by some philosophy of how to get there that is then implemented with extreme discipline. And I guess for that high level question, I would give you that high level answer.
Yes, it's actually understanding so much more beforehand rather than just, I guess a lot of people just go straight to the asset and think about that, just investing in that each sort of company or asset specifically, but it's actually taking a step back and having that understanding beforehand.
Yeah.
Yeah, no, thanks for running us through. And then I guess, going straight to the book, what influenced you to write it? I know you said you've released a few other books before, but why private equity?
Yeah. It doesn't make sense to write a book. Let's be clear. Like, I put out a podcast once a week, and the audience of the podcast is a multiple of the people who ever read this book. So, I think each time I've written a book, there was a specific reason why I wanted to put my thoughts down in that way. And in this case, I had started a separate podcast called Private Equity Deals because I just didn't feel like private equity was covered particularly well in this format. And you see a lot of venture capital, you see a lot of public markets investing, but private equity is this, huge asset base, and it pervades everything in the economy, every type of business. But the public doesn't really understand it. If you're in the institutional world, you have a pretty deep understanding of it. And the easiest way to get an understanding is to talk to the people who are doing it about what they're doing. So I did that on a series of podcasts, and it occurred to me, very much like David Rubenstein's done with How to Lead and How to Invest. Sometimes you take these different episodes, and if you put them together and package them together, you can get a different perspective than if you're just digesting it one at a time. So I just decided to do that, put some curation around it. Fairly simple way to put a book together and just put it out.
Okay, that makes sense. And I guess going to private equity, why do you think it's, I guess, not really understood, or a lot of people don't even know about it in the general public. So why do you think that's the case versus other forms of investing?
Yeah, this has been the case with all the alternative assets over the last 20 or 30 years, right? They start as sort of the provenance of leading edge institutions. And particularly in the US, the SEC prevents private investment partnerships, or until the last few years, prevented private investment partnerships from advertising. So if you were in private equity or you managed a hedge fund, you were not allowed to broadly go talk about what you're doing. You could only do it behind closed doors. And you blend investment strategies that are working with a regulation that prevents you from talking about it publicly. And all the public gets exposure to are the sensational outliers, both good and bad. And the good stuff you mostly would hear about in the venture capital world, because you'd have, the power law distribution, the Facebooks, the Ubers of the world, and people hear about that. The really good success stories in private equity, they're not so exceptional that they're going to make the news most of the time. And then on the left tail, yes, sometimes things go wrong. You go through a bad economic time, businesses struggle. There's leverage on a lot of these businesses, and so you do hear about those. So you get this skewed perception in the media of what private equity is, and it's generally skewed quite negative. But that really doesn't say much about anything about what all of this activity is underneath, and really what the core of it is, not just the negative outliers.
Yeah, and I guess it's the challenge of private equity overall. It is not all the time, but a lot of the time it is financial. You know, to the you're just pushing things to the extreme to get high returns through leverage. Would that be a the right way to put it, or how would you put it?
I wouldn't put it that way. I mean,
Yeah.
leverage is one of the tools of risk taking that a private equity firm can do. And if you go back to the early years in the 70s and 80s, lots of the businesses that were called leverage buyouts had a very high degree of leverage. It's just not that much the case anymore. And one way to think about it is if you looked at a particular company that had a certain cash flow stream, and then maybe banks or private credit lenders are willing to lend, say, 6 or 7 times EBITDA. Well, those businesses that maybe in the old days would trade at 7 or 8 times and now are at 13 or 14 times, at 7 times debt and 14 times enterprise value, you have a 50% debt to equity ratio. And so, yeah, they're levered, but they're not the massive extreme leverage that you used to have. So the financing leverage is one of the tools that private equity firms have at their disposal to try to increase returns. And for sure, if you increase leverage, you increase returns. You also increase risk. Um, that's one of the tools. The others tend to be in the operations and the way they find deals and how they exit deals. So there's a lot of different levers at their disposal in operating the companies as well as how they finance them.
Yeah, it's a good point, and maybe we can even take a step back. So for someone who maybe hasn't heard about it before, what is the difference between, I guess, yeah, you got venture capital. There's obviously public companies. So what's the difference between those and sort of the private equity market?
Yeah. Sometimes they're all couched together. You could think of public equities as anything that's listed and private as anything that's not. Generally speaking, or how what I was writing about in the book is the later stage end of it. So if you start with early stage venture capital, you have those seed rounds and early stage and businesses that are not yet profitable. They may get profitable. You may have growth equity rounds. You could have a public offering after that. Um, Generally, when I think of private equity for this deal, sometimes synonymous with leverage buyouts. As I mentioned, sometimes there's not as much leverage or no leverage at all. They tend to be either later stage businesses or they're mature businesses. They just happen to be privately owned. So sometimes those are public companies that get taken private. Sometimes maybe it's a family owned business that a private equity firm comes in and buys from them. So there's a lot of different sources for where they are purchased by a private equity firm. Uh, but what we're talking about in the book are these later stage companies. They're generally profitable, though there are some distress situations, some turnaround situations, but they're generally profitable cash flowing businesses where a private equity firm comes in and puts some leverage on it and then runs it from there.
Yeah, and I think cash flow is the key thing. A lot of the time, especially depends how much debt you're using, but ideally they need to be cash flow positive to be able to pay off the interest, or pay off the debt. Is that sort of, yeah, what they're looking for?
There's a lot of different, I mean, private
Yeah.
equity is so broad. It's like 10,000 companies. It's hard to characterize it and say they are looking for this. What I did in the book was break it down into two different types of deals. So I called them at the market deals and below market deals. So you could think of the at the market deals as what you're describing. So maybe a competitive transaction, a good business, something you'd want to own for a long time. You might come in, you might buy it. It's probably a competitive auction. You have to pay a lot to get that business. And then you're going to do whatever you can to both improve the business and finance it appropriately. The off the market transactions are the opposite. So it's generally something's wrong. And it could be something's wrong because it's complicated, like a carve out of a corporation. It's very messy. It's not an easy deal to do, either to actually buy the business or then to run it. And you have to sort of transition it from a corporate owner into an independent entity. You have certain turnaround situations or distress situations, or just one off kind of orphaned assets. So those, while sometimes there are cash flow, positive cash flow characteristics that they're underwriting, and other times they're underwriting a very, very different operating trajectory from the one the business had up until the point in time where the private equity firms come in and bought the company.
Yeah, I imagine the second one is maybe where they get a bit of a bad name because it's very high risk, very hard to. It's not always the case where you can turn it around, but then it also looks bad if you put all this debt on it, it fails, and then yeah, people lose their jobs. I think that's what a lot of people look at.
Yeah, I mean, you can encumber risk in companies in lots of different ways. So one of the ways people point to is financing risk, as you said. Like you could put a lot of leverage on a business, and that magnifies the returns up and down. Um, Another way of incurring risk is paying too much. Right? You could have a great business but pay too much and not have a good outcome as a result of that. And another is buying a business that needs to be turned around and then not being able to turn it around. Right, a distressed situation that doesn't get better can be very risky. And most of the time, risk isn't just the nature of the business, but it's also the price you pay. So you can have a struggling situation where someone has a very clear plan to turn it around, but they don't have to pay a lot because of that, because of the current state of the business, and that can mitigate the risk quite a bit.
Yeah, and then so I guess certain partnerships, would they sort of focus on specific industries, or is it very broad, or does it just depend on the type of partnership that sort of forms?
Yeah, in the book, I highlight 12 different deals, and they canvas everything. There's a garage door company, ownership of a sports team, the Yellowstone Club, which is a luxury resort and ski experience, Yahoo. So really everything, and private equity across the industry, something like 10,000 companies. So it's everywhere. It's in every sector. It's part of the global economy in a very, very significant way. So many private equity firms may have a specialty in a certain type of deal or a certain industry. But when you look horizontally across private equity firms, there's a little bit of absolutely everything, every geography, every sector.
Okay. No, that makes sense. And I know I think they've sort of come to the forefront. You've mentioned that, I guess there's more money flowing around in private equity, so they're obviously going to, yeah, be better known. But I know a lot of them have turned public as well. So I think Apollo is a very well known one. So do you think that's just sort of, these institutions are getting so large, they're becoming more well known. So now people are realizing what's actually happening. Do you think that's the case?
Um, it depends what you mean by people, right? This is a multi-trillion-dollar industry, so it's not necessarily undiscovered by the institutional capital, though in the public, maybe it's less well known. There are a few public companies, not many. They tend to be the larger multi-strategy alternatives firms. So you mentioned Apollo or KKR, Blackstone, and Ares, but there's probably only a half a dozen to a dozen of them, and there are probably thousands of private equity firms.
Okay. And I guess it's the same for hedge funds and other places, that there's probably the case where I'm assuming that it's not. Do you think it will become more common? Because I know a lot of the reasons they do that is to sort of, I guess, yeah, realize the equity in these firms potentially for the partners to, yeah, be able to exit. So do you think this is going to be, yeah, more common moving forward, or just depends?
Yeah, um, it, I think there will be some more, but it's really only companies that should be public companies. They're going to be large scale, diversified. There were some hedge funds that went public. So you think of Oxif, which is now Sculptor and Fortress, really starting before the global financial crisis. And I don't think you'll see many more hedge funds go public. There are a few that could, but not many. And on the private equity side and the rest of alternatives, There are probably a few more that will come along the way. You do hear about them from time to time, but not most. I mean, there are benefits of going public and having currency to compensate people, having capital, access to capital to start new strategies, but there are drawbacks as well, right? You've just brought in a whole nother constituent in the shareholder base, the ownership of the company, whereas many private equity firms are just owned by the principals. So there's pluses and minuses of being a public entity for sure.
Yeah, more stakeholders, more regulatory factors to take into account, higher costs, etc. So yeah, not always easy. But if we sort of focus, I guess, on the private equity space of the past few years, I think you know it's really, from what I know, it's sort of really increased when debt was low, or that was what I guess there's lots of liquidity in the markets. People were looking for higher returns, so they're sort of trying to push along the risk curve and try and find other ways to get those returns. But it did seem sort of after COVID, when we saw the interest rates rising, there was sort of a bit of pressure that came into the market. Is that something, I guess, that you saw that people have been talking about, or is that maybe not as much the case? Yeah, what did you see there?
Well, there's been a big move over the last, say, 20 years of portfolios trying to diversify away from just listed equities and bonds. And that started maybe 30 years ago in the institutional market and has pervaded that particularly since the financial crisis. And now you're seeing that interest more in the private wealth channel. And it's probably driven as much by some concern over what prospective returns might be in just a standard stock bond portfolio. It's hard because people look back and say, well, that's been an incredibly great place to be. That interest rates on a downward trend for 40 years. The stock market, particularly in the US, has been extremely strong for a long time. So just having a 60-40 or 70-30 portfolio has probably been as good as you can get. I think when you look out, most people don't necessarily think that recent history is going to repeat itself going forward. So then you have this question of, okay, what else can you do with your capital? And places like private equity, to a lesser extent, hedge funds, private credit have been homes for capital that have really delivered on the return needs of the owners of that capital for a long time. And that's where the interest is coming from. It's accelerated in the last 10 or 15 years. And it's maybe slowing a little bit now, but I think for the most part, it's a long-term trend.
Okay, so because I know there's been a bit of talk about, I guess, pain in, or the inability to be able to, I guess, have rotation out of companies. Because I think a lot of the time, yeah, this is obviously very dependent on the strategy, but sometimes these companies are looking to buy, improve the company over a couple of years, and then sell to be able to reimburse the investors. But it seems like there has been maybe not as much capital flowing around because of these higher interest rates. There's been that struggle. Is that something, or you think that's the case for some, but maybe not an issue for everyone?
Well, across private equity, you've had a dynamic where, particularly leading into, say, the fall of 21, many private equity firms were coming back to the market faster than they had historically and raising more capital. So there was a lot of money and a real acceleration in the money that went into private equity and growth equity and venture capital. Then you had that hiccup in 2021, and you fast forward a couple of years, there's been a lot less liquidity on the back end. So the investors that have a certain allocation of their capital to private equity who have been there for a while, that's probably gone up a little bit because they've been investing steadily, but the distribution side on the back end has slowed materially the last few years. And so in the more mature parts of the allocation space for private equity, think endowments, foundations, certain pension funds, established family offices, they're slowing down their new investments into private equity until these distributions come back. There are other pools of capital like private wealth, some insurance companies, particularly in the private credit world, and some of the newer sovereign wealth funds that continue to deploy capital into private equity. So as an industry as a whole, it continues to grow, slightly slower pace than it's been in the past. And that'll normalize over the next couple of years and probably continue at a very healthy trajectory for a long time.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people. And you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So, yeah, if you can, great. If not, no problem at all. Thanks for listening. And, yep, let's get back to the show. Yeah, and I imagine there's more companies because I'm based in the UK, and you see it all the time where these publicly listed companies are sort of acquired because I guess there's potentially a lower valuation, or they see an interesting company, and I guess as more companies go private, then there's less public companies that you can invest in, so you have to sort of try and look in other avenues, and that's what these larger investors might look for. Yeah, and then when you say diversification, I guess from public markets, do you see it? Because I know there's been quite a lot of research, and a lot of people say it's very correlative, especially if there's drawdowns. Do you see it maybe taking a percentage of the 60%, or do you think that people will start to maybe go higher to public and private equity?
It depends where people are starting from. I think, in the institutional, at the high end, you have as much as 50% of capital in private strategies. And then if you look at a lot of the private wealth channel, that might be 2 or 3 or 4%. There's a big difference between, say, 5% and 50%. And that's where you're seeing that incremental growth by the shift in asset allocation. But a lot of investors have been engaging in private equity for a long time, and they have relatively mature portfolios. Then their pace of investment or new investment is going to be dictated by what's coming back to them and how are the other assets in their portfolio going, because they're at a stage, maybe they have 30 or 40% of their capital in private assets, and that's where they want to be. So they'll continue to do that, and as their capital base grows, they'll deploy more capital into private equity. But if the capital base shrinks a little bit or other assets do better or worse, they're going to adjust accordingly.
Yeah, it's always adjusting. I guess that's a challenge that all investors have, no matter the asset class. Um, but yeah, if you mentioned that there's quite a few different deals and different stories that you go over throughout the book. So I guess from your perspective, that you've obviously picked them because they stand out. But were there any that really stood out to you and surprised you, or that you found really interesting when writing the book?
Yeah, there's a lot of different ones, and it kind of depends on your appetite and flavor. So I'll give you a couple. There's one. The first story in the book is a company called CHI Overhead Doors. It's a garage door company bought by KKR, and they manufacture garage doors. So there's a bunch of interesting dynamics to it. One is that KKR was the fourth private equity owner. So this is just a great business. It's a business that generates steady cash flow, has competitive moats. There's a bunch of things they do that really differentiate them from their competition. They've had great management teams. And so private equity firms have owned it and done well and sold it to another private equity firm. KKR came in, and it took 4 owners for it to grow large enough where it was in KKR's sweet spot because they're such a large player. And they did something that they have done first in the manufacturing sector and now across all their companies, which is very broadly distribute equity to the employees. So typically, to align incentives, a private equity firm will have great incentives with the management team to have them own equity and give them great motivation to grow the value of the business. But KKR did it across the company. So think manufacturing line workers, truck drivers, and it ended up being a tremendous success. So much so that when they sold the business 7 years later, it was one of the highest returning deals in KKR's history. They had put in $250 million of equity in the business. And when they sold it, they gave out $350 million to the employees. So just a great story of how you can align your incentives with the people on the company and get extraordinary returns as a result.
Yeah, I think that's something that all companies can learn. How can you yeah, align people with the benefits of a successful company rather than just a paycheck and then they go home, or let's be honest, it doesn't always motivate us if you don't
Yeah,
have
exactly.
a stake in the business. So do you see things like that a lot, or is that just like a really interesting example of where it's done well? Is that something that KKR does quite a bit?
Yeah, I mean, KKR has done it, and Pete Stavros, who's their global head of private equity, believes so deeply in the model that he created a nonprofit called Ownership Works, and wanted to share the lessons of what works, not just the concept of giving equity, but how do you do it? How do you implement it? How do you motivate the people so they understand the value of it? In an event of success, how do you prepare them for a potential financial windfall? And they've shared all those lessons across the industry. So there are lots of other private equity firms now that are trying to employ it as well in many of their companies. So I think KKR has been a real leader in advancing the interests of employees through this model. But they don't want to be the only one who's doing it. In fact, they're sharing the best practices as broadly as they can across the industry.
Yeah, because I guess that's a story that you don't see in the news of trying to, yeah, share the equity with the employees. It's sort of more the other way that you're firing, you're, extracting, you're leveraging, and then dividends, and maybe not putting the company in the best place. So it's trying to have that, other perspective on what private equity can provide.
Yeah.
Yeah, interesting. And then I guess are there any other stories, or maybe any that sort of that's obviously quite a positive one. Are there any that sort of maybe had the opposite effect on you?
Yeah. I mean, I didn't cover any stories that didn't work out, and that's a bias, right? You're doing this publicly. Private equity firms are going to pick the deals, and I try to minimize that cherry picking. But for the most part, these are 12 stories that have been successful. I'll say that KKR had exited that deal. 10 of the 12 in the book are live deals. So lots can happen. And I don't know how they'll turn out. And for the most part, I think these deals are probably off to a good start. But many of them are still in process, and we'll see what happens. I mean, there is one company in the book, a company called RealPage that Toma Bravo purchased, and they are a vertical software company for real estate owners. Um, it's been a very good business for a long time. It's gotten in the crosshairs of politics in the U.S. because one of the many tools that they have for property owners is an algorithm to help them figure out pricing. And there's been regulatory scrutiny that they may be contributing to rises in prices for renters. So we're going to have to see how that plays out and how it, may hurt the business. But that came up, after we discussed the story in the book. So a lot can happen from when you buy a company to when you sell it.
Yeah, and that's a challenge. And then would you say that, yeah, most of the time the end goal is to sell it and then to redistribute that capital in another business that you can grow? Is that not? I guess it's some that sort of going to hold the business forever. But I guess most of the time they're trying to sell and then reinvest or redistribute back to the shareholders.
Yeah, the private equity model is structured to invest capital over a couple of years, harvest it over several more, and then sell the business. Um, that's how the model is set up. That's the deal that's set up between the private equity firm and their investors. There are different ways that private equity firm might extend the term of their ownership of a company, but they're not designed to be permanent owners of assets. So that's just part and parcel with the model.
Okay, yeah, that makes sense. I guess where do you see the industry going forward? Do you just see it? Obviously, it's hard to predict, but do you see it just becoming bigger and a bigger part of the economy and markets, or do you see anything else uh, that could be interesting?
Yeah. I mean, my first mentor, David Swenson, who ran the Yale Endowment until he passed away, described private equity as a superior form of capitalism. And what he meant by that is when you're the ultimate owner of the business, it's just a better way to compound capital. You have control over operations. You can keep a management team. You could change a management team. You can improve operations. You can keep them going when they're working. Uh, and it's proven out. I mean, private equity firms generally, on average, over the last 20 years, have added about 500 basis points of return over the market, and investors want that. So, yeah, I think it's a place that's been a great place to be for investors. Um, will go through its own cycles. We might be closer to the top of a cycle than a bottom, but from a secular perspective, I think you're going to see the continued growth in private equity deployment for a long time to come.
Yeah, and do you see, in the UK, they're sort of trying to, I don't know if they did bring it in, but they talking about bringing in a carried interest sort of tax or trying to, increase. They saw it as sort of tax avoidance. Do you think that's something that could impact, I guess, the returns and then potentially the benefits of private equity, or do you think it's just going to, dependent on what policymakers want to do and things will continue the way they are?
There's been discussion about changes in carried interest tax policy for a long time in the US. It baffles me why they're still taxed to capital gains and not ordinary rates. But no, I don't think that will ultimately affect any of the activity or any of the behavior by the principals. It's not something that affects the returns of the investors. It's just the tax treatment of the income or capital gains made by the owners of the private equity firms.
Yeah, I'm sure they'll be doing fine regardless, I'm sure. But yeah, Ted, thanks so much for your time today. We sort of covered quite a lot. So my last message is, what is one thing you want to take that you want people to take away from our conversation as well as the book?
Yeah. Well, thanks, Anthony. I appreciate coming on the show. Um, I just encourage people to learn what they can about private equity because it's such an important sector of the economy and will be for a long time to come.
Great message. So thanks again. If anyone wanted to find out more about your work or the book, where would the best places for that be?
Yep. Everything's housed at our website, capitalallocators.com. Free monthly mailing list. I think I'm on LinkedIn and Twitter, and we post a lot of things there as well.
Perfect. I'll put that in the description below, but thanks again for your time.
Thank you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback, I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.